and I'm joined by Tarantula today on Thursday, the 18th of July, 2013. So good evening, everyone. I just want to check, first of all, if you can hear me, and if you also see the visual PowerPoint, and then we can move on from there. We'll go through basics, of course, the risk disclaimer, and then we'll dive into these indicators. I'm sure you're excited about that. I think it's must be a popular topic, I would say. Oh, okay, great. I got some confirmations here. I think it's going to be a very popular topic. Normally indicators are. So let's see. How to trade using classical indicators with Admiral Markets. First of all, please take a look at Admiral Markets websites, for example, like the market depth and great spreads. You can see, of course, with our trading session together at Admiral Markets, how great those spreads are. So please really take a look and seriously consider Admiral Markets as your broker, because I can't imagine getting better than that. All right? The risk disclaimer, of course, as always, explaining that trading foreign exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar and recording is for educational purposes only. So thanks for your attention on that. Today's goal, an explanation how traders use indicators for trading. So we're going to take a look at what is an indicator, spelling mistake there, why is it important, how can we use it, the classification of indicators, and some strategies. All right? So we've got some great stuff going on here. Tarantula is, I don't think there yet, but we're going to take a look at the classifications here of indicators. So for example, we have leading indicators, right, oscillators. For example, divergence is an example of what could be considered a leading indicator, because most of them are lagging indicators, like the momentum ones. The leading indicators could be a CCI, RSI, stochastics, for example. Now that's very important to have that information, and even I think people who trade basically naked most of the time use these leading indicators. I mean, you have maybe a few traders who really trade without anything, only look at price action, that can't even get more naked than that. But I think even people who are really focused on price action most of the time do even have a one leading indicator, I would say. It's quite typical. Okay. So now, of course, you have other extremes where people have tons of indicators, and maybe too much because you can't even see the chart. It's totally blocked with all kind of information and indicators, and this leads to over-analysis, paralysis of analysis, overloads, and could be actually backfiring and be very ineffective because you don't know what to do with that information. And that's the most important.
Guys, sorry.
Yeah.
Chris, welcome. Sorry for a little delay. I had some problems with my microphone, so okay. Excellent. We can hear now each other.
Yeah, exactly.
Okay, guys, we can start, right? We can start. I think that we need to first explain what are Forex indicators and why we use Forex indicators. So first of all, I would like to, just prior to explanation of leading and lagging indicators, I would like to say what are indicators, and just brief explanation of indicators. So basically, indicator is something that tells us something, and the Forex indicator is a mirror of price action. So we will use indicators as a mathematical calculation based on a price. So we use that statistics to measure current conditions as well as to forecast financial or, let's say, economic trends. And the main purpose of using indicator is to define trend, to confirm a trend and entry, and to place stop loss and target price or take profit. So that's a brief explanation of indicators, and of course there is a subsequent classification and of leading and lagging indicators. First of all, let's see that the best leading indicator for me is the price itself. And that means the price, I'm talking about price action. That means those candlesticks that form during our trading. For me, that is the best indicator. But let's, because we are talking today about technical indicators, about statistical indicators, we need to now stay above that price and mention the price mirror. And those are those technical indicators. So there are two main groups of indicators: leading, called oscillators, and lagging, called momentum indicators. A leading indicator gives us a signal before the new trend or a reversal occurs. A lagging indicator gives us a signal after the trend has started and basically informs us that the trend has already started. That means that we are a little bit late in the trend, but that is maybe a better confirmation than a leading indicator. So lagging indicators gives signals only after the price changes clearly form the trend. I know that the downside is that we are maybe a little late in entering a position, but as you already know, the first earliest entry that we can ever have is caused by divergence. So that is, I would say that that is not a real downside to using a lagging indicators. Just because we are lagging a bit, that doesn't mean that we won't have a profitable trade. And you know, we don't always have to be earliest at the entry price. So it's always better to wait for a first swing and then enter the market, and basically that is what lagging indicators gives us, the possibility to enter after the trend has been confirmed. Well, you know, when I start trading, I thought that only leading indicators and only lagging indicators can give me some good trading systems or strategy that I can use. But later I have figured that basically all we need is basically a leading indicator and a lagging indicator combined. So the combination of a leading indicator, whatever you choose, and a lagging indicator, again whatever you choose, should give you the best results. I'm not trading completely naked, because in my analysis I use forex patterns, I use candlesticks. But when I make entries, I always use my favorite indicators, that is MACD. But prior to that, of course, I have tested many of those indicators, and I can say that three top leading indicators are CCI, Commodity Channel Index, RSI, and stochastics. Those are the leading indicators, so they lead the price. So basically, looking at CCI, RSI, or stochastic is looking at the price itself. Well, let's say three again, but I needed to put a RSI also as a momentum indicator. Top three lagging indicators are MACD, momentum, and rate of change, also known as ROC indicator. Also, RSI can be used as momentum indicator. I will show you a trading strategy a little bit later, so you will see how RSI is also a momentum indicator, because RSI, it is a leading, but can also be seen as momentum indicator. Also, I need to say what are oscillators and what are trend following or momentum indicators. Now listen to me very carefully, because those are definitions. I think that you should know what oscillators are and why you should use it. Let's say that oscillators are a group of indicators that confine the theoretically infinite range of the price action into more practical limits. Why they were developed? They were developed due to the difficulty of identifying, let's say, a high or low value in the course of trading. Although we may have some mental concepts of what is high or low in a typical day trade or the price action, the very chaotic nature of trading means that any high can be easily penetrated by another one that sometimes follows on the heels of a previous record and negates it swiftly. Oscillators aim to solve that problem by identifying those levels, indicator levels, that hint at tops or bottoms and helping us in making our decision process. So why should we use oscillators? Well, there are two ways of using oscillators. The first, maybe, and the most prominent, is that oscillators can identify turning points, tops and bottoms, and this style is very useful when we trade ranges. We will, one of our next webinars will be range trading, and I will and Chris will show you a heavy use of oscillators when trading range markets. So oscillators are much better in trading range markets than price action itself, because they are specially developed by using special algorithms and formulas to delve deep into market's mind. And you know that market is ranging 70% of the time, sometimes even more. Sometimes even more. So oscillators are also used in trending markets, but in that case, the only purpose is joining the trend. Highs or lows, tops or bottoms, whatever is used for entering a trade in the direction of the main trend. So those are oscillators, primarily used in ranging markets. They define tops and bottoms, they define turning points, and we use it when trading ranges. If they are used in trading trending markets, then we only use it to join the trend. You probably know that when we see, for example, stochastics protruding from down below 20 level, and usually we say when it breaks that 20 level, let's go into the trade. That's called joining the trend. But you will see in our next webinar about ranging markets and how to trade ranging markets, you will see heavy use of those oscillators, because it's really easier to do it than to follow a pure price action. You have additional confirmation. You have a special algorithm invested in that kind of indicator to tell you whether you should join or not. But let's talk now a little bit about leading indicators, lagging indicators or momentum indicators. So what is momentum? When I say momentum in my language, I know how to describe, but because we are having an international webinar now, I will give you a pure and simple example of how momentum looks like. So let's talk about pendulum. Pendulum, you know what pendulum is. I think they all know what pendulum is, Chris, right?
Yeah,
pendulum.
For sure.
Yeah, it's the thing that swings usually below the big clock, big clock. So it's a pendulum. It can be a pendulum also. It swings. It goes up, it goes down, then again it goes up, making an arc. So the term momentum has a specific meaning in physics, and let's say that the speed of a swinging pendulum will vary along the vertical axis. For example, as the pendulum moves from the bottom to the uppermost extent of its oscillation. Although the vertical movement of the pendulum is zero, nothing, at the top of its range, the force is acting on it at the same point is maximum. So, as the pendulum reaches its maximum speed, the forces generating the speed are at that minimum. So the oscillation of force and speed that creates the observed back and forth movement in the pendulum is similar to the oscillation of prices in the market, because prices move between successive extremes, and the speed of price action reaches its maximum at a point where the entry of new traders or money has peaked. So this is very important. The speed of the price action will reach its maximum at the point where the entry of new traders or money has peaked. Because of that, the trend will continue to generate new highs in all likelihood unless the continuous nature of the price action is broken by an unexpected event, let's say the news or data release. But since the amount of new buyers or sellers steadily decreases, achieving and sustaining new highs will be harder. And that is the same case with the pendulum. As the driving force of the trend dries out, opponents of the trend, counter-trend traders, will sooner or later achieve dominance and will drive the price action in the opposite direction. So, momentum indicators aim to characterize and portray these swings of the price, ups and downs. So, let's say that the momentum is very important because it helps us to place the price action into the context of our enthusiasm, which then enables the determination of the underlying trend strength. So it helps us to make that final decision. It helps us to see trend more clearly. That is why using one of those lagging indicators is very important. And you know, Chris' favorite is awesome oscillator, right, Chris? And mine is MACD. Maybe they're more or less, they're not the same, but they're really similar in their nature.
Yes, definitely.
So we really, I can say that it is very, very important to use also that lagging indicator, momentum, because, you know, as I already explained, you will join the already established trend. You won't guess whether the trend will change or not. You will join the already established trend. So think about it as a pendulum going up and down. You want to go when momentum has already started, because then you will join in a trend. You will join the majority of the market players. Whatever time frame you are trading at, it doesn't matter. Momentum can exist in all time frames, even on 1 minute time frame, of course, because trend exists in each of time frames. So there is well, not a brief, but there is a thorough explanation of those leading and lagging indicators. Chris, do you have anything to add? Mm-hmm.
Yeah, I just wanted to say, I just would add, basically, really not much, but just a couple of things regarding the indicators that you want to be careful indeed for over-combining them. What we said in the beginning, just to emphasize that you don't have to make it that complicated. As Tarantula is saying, keeping it simple to a combination of these is the best, and definitely no need to over-combine or overuse them to such a degree that the whole chart is filled up with indicators and you don't even see price, for example. And another thing maybe that could be good, just want to emphasize, is the fact that no matter how much you tinker with these indicators, you know, there is a certain level that you're not going to get better with these indicators. You know, a degree less or more. It's good to practice with them and find the settings you like, but there is a certain maximum. You don't want to start looking for the well-known holy grail until the 5 o'clock morning sun rises and you wonder where the time was. So be careful with that as well, I guess. It was just as a warning regarding indicators. They could become a bit of addictive sometimes, I have a feeling, because they are interesting. They do you know, show interesting information, especially if you look in the back and do some back testing, and you can see a lot of interesting stuff going on. So they can be sometimes maybe a bit addictive. They're definitely a very important supportive tool, but don't underestimate the value of price action, what we've already discussed in previous webinars in candlestick patterns and stuff like that. So
yes, and I will show you later in an example how you can combine a leading indicator and a lagging indicator with a moving average. Because moving average, I will talk about it now. It's a separate thing. So let's say that you want
discussed this slide.
Mm-hmm. Mm-hmm.
We already discussed this slide, I think, right?
Mm-hmm.
Okay.
So it is very important not to over-combine, as Chris said. So never go with more than one leading indicator and one lagging indicator, because you don't need it. The most successful of each of those indicators will prevail. So what is the purpose of using multiple lagging and multiple leading indicators? Believe me, it doesn't have any purpose. The only purpose is for those marketeers to take the money out of your pocket selling various systems over the internet. Most of them are con men, and most of them will take the last cent from you to teach you some special indicators or some custom-made indicators. Those are all fakes. All of those custom indicators are based on these well-established classical indicators. So my advice is never to use on any of those systems that sell for $97 or something like that. You should just, we will show you some strategies, you should practice it, and this is the most important thing, never combine with more than one leading and one lagging indicator. Moving averages are the separate indicator. They don't, they're basically lagging in nature, but we cannot put them in any of those classifications. Moving averages are not leading, they're lagging, but not lagging completely, and they're basically the dynamic support and resistance levels. So I would like to say that moving averages, we cannot classify them in any of above mentioned sorts of indicators. They are not leading nor they are lagging. They are separate tool because they are support and resistance indicator. They depict dynamic support and resistance levels. Moving averages are technical tools designed to measure the momentum and direction of a trend. So they are giving us a great support and resistance levels. Well, what is the idea behind the creating moving averages? Price action is known to fluctuate around the average value over a period of time. And we can expect to be able to represent the market's momentum by calculating if the current prices are above or below the market's average value. So there are 4 different calculations of moving average. Those are simple, exponential, smoothed, and linear moving average. So they act as dynamic support resistance levels. They are lagging a bit, but they are excellent tool for determining a bigger trend on every time frame. So we can use 5-minute time frame and see support, resistance, and trend on 1-hour time frame. Simple moving average is the most basic of these tools. It sums the closing prices over a specified time and divides them by duration of the period. So no weighting is used and no smoothing factor is applied. It's a simple, as it say, simple moving average. Exponential moving average is most used of all indicators for moving average classification. It's maybe, let's say that weighting of moving average is done exponentially. In other words, as we move to the left on the chart towards past values, the weighting that they receive in the computation of moving averages decreases rapidly. And the most recent prices are far more significant. And that is very good because we can combine mostly on lower time frames. So exponential moving averages are really excellent tool in lower time frames. Smoothing moving average is similar to exponential except that it takes all available data into account. So it's mostly used to smoothen the price section, removing short-term volatility, allowing us a better picture, a better understanding of the long-term momentum. But we don't use smoothing moving average on lower time frames. We have also last moving average that is linear regressed moving average or short LMA. So the weighting factors are linear, they are not exponential. So I won't go into deep mathematics, but let's say that the most recent prices receive greater emphasis, and the latest fluctuation, rises or falls, are depicted with greater clarity, aiding trade decisions. So linear regress moving average can also be combined within a good strategy. I think that I have a strategy using LMA for counter trend. I will check that. So when we have a counter trend webinar, I will show you linear regress moving average if it's correct, if I remember correctly. I also need to add a special kind of indicator that can be used also as a leading indicator, and it's an oscillator, and it's called Williams percent range oscillator or indicator. It is I will show you later the strategy which uses Larry Williams indicator, and I will explain you what that kind of oscillator is, because we can put it in a leading indicators theory, but it can also be used as a great tool for entering the market. It's a good thing because it signals a possible entry. So we can also use it as a signal as a possible reversal. So it can be used as a turning point, and also it can be used as a entry point. It's very interesting. I will show you later the strategy. Do you have anything to add for this moving average, Chris?
No, basically I think you explained it perfectly. It's a great tool, a great indicator. I love it. Not necessarily maybe for entries, although it's definitely possible, but it's just a great way to measure, I think, as I've said in previous webinars, the psychology of the market. It's a simple yet quite fascinating tool if you think about it. So no, that's great stuff.
Excellent, because I know that many traders will use those crossovers of moving averages to enter the market. I don't suggest that kind of approach, because moving averages are lagging, as we already know, and they are basically mostly they're used as a great support and resistance levels. Yeah. So combining them into crossovers, it's not a good strategy.
No.
So my advice, and I think Chris is agreeing with me, that you never use crossover strategies. They are not profitable. They will lag, especially in lower time frames, and they can whipsaw your account, giving you many false signals across time frames.
Exactly. They're a great indication of, if you use them on multiple time frames, which we also discussed in a previous webinar together. They're a great indication when you browse those multiple time frames to see where that potential resistance and support could lie. Indeed, absolutely. Yeah, definitely. By the way, Tarantula, I plan now to, after this classification of indicators, to discuss my favorite indicator.
Of course, yes.
Yeah?
That's okay, of course. I know that your favorite indicator is, and our listeners at these will also know what your favorite, because I also I respect that kind of indicator, and because it's very similar to my MACD. So of course,
definitely,
I'm with you, Chris. Of course.
So I had it planned after this slide to take a look at, some of you probably already know, at the awesome oscillator. That's decided just to focus on this one into a bit more depth. So in detail, we had a great explanation of what is an indicator, what do we do with it, what does it mean, how do we derive it from Tarantula. Now I'm just going to dive into one specific indicator a bit more. I think the reason why I chose this one is indeed because it's my favorite, and I think it has such a great value to the addition of looking at price and fibs and all the tools you might be using. Right? I think it's definitely a very valuable tool, and it's very similar to the MACD, and I'll be showing you how I use it. And I think that it's definitely worth your attention, because I think, even if you know some of this stuff, I think it's good to review it. And it's just you'll see all the different levels and manners I use this one particular indicator. So basically it's been developed by Bill Williams, who's a trader himself. And It's called the oscillator, AO for short. We'll be using that. And it's the difference between a 34 period and a 5 period simple moving average of the bar's midpoints. Okay, so high plus low divided by 2, and then you'll get an indication. If the histograms are red, we're having a down movement. If it's green, the histograms are going up. All right, so it's red is of course lower than the preceding bar. The green is the opposite, indicating the up or down momentum. Now there's more to it than that, but this is just explanation how the AO is calculated. All right, so you can see the similarity between the MACD, and it's all derived from the same tools, the same units of, the same indicator, basically the moving average. So here's the example, just a plain empty chart of the pound yen by coincidence 4-hour chart, and you can see price above and the AO at the bottom, and you can see how basically there's a middle line, which is the 0 line, and otherwise the histograms are moving up and they're above the 0 line, or they could be moving down and below the 0 line, or they could be moving down and above. That would be more of a retracement, right? Here is moving back to the 0 line, here it's moving away from the 0 line. Just like when the histogram is below the 0 line, it could either move back towards the 0 line or away from the 0 line. Okay? Simple stuff, right? So this is all the methods, the advantages I see by using the AO, the interpretation of the AO. Basically, I summed up 8 points, how I use it. So I'll just go one by one. We'll explain all of them. This is just a summary. But the first 2, for example, are regarding the color and the 0 line itself. Number 3 and 4, you're really looking at divergences, of course, just like the MACD. And I use it as well for edited wave counting, which you probably could do with the MACD as well, but I'm using it. I use the AO for that. Then the 5th is the distinguishing of the separate swing highs, swing lows. It's possible as well. Then that 4 also leans itself for anticipating and knowing where to place the fibs. And 7 would be the retracement minimum requirement has been met. We'll talk about that in a second. We'll discuss all of them, by the way. And then 8, we actually use the AO for the 4-hour strategy, which has been explained in a separate webinar regarding intra-week / volume strategies a few weeks back. Okay, so you can find that in the video archive. We discussed this 4-hour strategy based on the AO in great detail in that webinar. So let's dive into those separate numbers and discuss them a bit more in depth. So basically, when you change the color, very simply put, these first 2 items are quite intuitive, I think. But basically, when you change the color, of course, from red to green, that is showing an indication of momentum shift. Tarantula is also talking about that momentum, very important. So basically, if you have an uptrend and price is pushing up and the oscillator is following, we have histograms that are green, and then if the histogram goes to red, that is indicating that the price is basically pulling down the 5 moving average, and the 34 is catching up, or the 5 and 34 are nearing each other, closing in, and we're getting turned to red. Right? The momentum to the upside is decreasing. So I think that's obvious, I hope, but if you have a question, let me know. And then we have the 0 line, which I already talked about, that line halfway. And basically, that's an important area. Not necessarily is a crossover of that histogram over the 0 line right away an indication of an opposite direction, but it is an important line that can indicate a retracement. We'll talk about it a bit later, or a continuation of a trend reversal. So it is an important line to be aware of. The 0 line has definitely an indication that we want to be aware of, and we'll talk about that in a moment a bit more. Basically, what it boils down to is that if you have a very strong histogram reading to the downside, and the histogram is back to the zero line and just maybe barely above the zero line even, then you want to take a look at where was the momentum shift power in the past. And if it's now just barely above the zero line, that is usually a retracement. I'll maybe have an example here, which would help with the explanation. You can see, for example, clearly that the momentum shift here was above the zero line, moving to the upside. And when we get back to the zero line here, it's an important indication that the retracement could be fulfilled, and that when we change the color back to green here, we could see the continuation of this uptrend to the upside, okay? Just like here and here, okay? So that could be an indication when a retracement is ready and the trend can continue. And when you have, for example, color changes and the move back above the zero line in the original trend direction, so this move under the zero line is not that important, all right? It's still counter trend, but if it moves back in the original direction of the trend, so trend definition very important, then it does become interesting. Okay? Both moments, as you can see. So what else can we use it for? Those are the basic explanations of the tool. These are the basic usages. Now we dive into a bit more maybe sophisticated explanations regarding the AO, and which for me I believe has the biggest value. I think this has a very high value for me as a trader, and I think it's very valuable information here. And if you aspire to trade in a similar direction as I trade, then I think this is invaluable advice personally. I can't emphasize it more. Third is basically that we use it for divergence and convergence. Okay, that's still pretty simple actually. It's basically looking for a confirmation of price if it's converging in the particular trend. So if we have, for example, I'll move back to this chart. If we have, for example, a higher high here, HH, and we have a higher high here again, the oscillator is confirming that with two higher highs as well. So that's convergence. We've talked about this webinar as well. Unfortunately, I think that wasn't recorded. It's a shame because it's definitely an important aspect of trading, divergence and convergence. Here, for example, we have another peak, okay? And here we have a higher high in price, but the oscillator clearly having a higher low. And there we can see that the price is not the oscillator, the indicator is not confirming the new price highs, and we have a three-wave correction that takes place, a deep correction after that divergence. All right, and then we still continue with that trend. So very important stuff. Now, that's the divergence and convergence. I mentioned this, explained in a separate webinar. Unfortunately, I didn't realize that it wasn't taped. I hope, we cannot dive into that too long because this webinar is not really focused on that. But I hope that this explanation in itself really is clear and helps you with that. And it's definitely very valuable for that, okay? Now, you want to be aware, though, that the oscillator, I wanted to mention it a bit later, but maybe I'll do it right now, is there are basically, when you compare highs with each other, you do want to make sure that the oscillator has returned to the zero line. All right, that's important because otherwise you're not comparing apples to apples. If the AO wouldn't have, now in this case we have three highs, and in both cases the AO has returned to the zero line in between. So there's a fair comparison in time factor to compare those highs. And we can clearly see that one is convergence and the other is divergence. That's a good assumption. This is called regular convergence and regular divergence. Now, if we do not have that movement back to the zero line, for example, if you would compare these two highs with each other, this is in fact not regular divergence or convergence. This is actually called bad convergence because they're converging. If it were to be, let's say, here, maybe, this could be maybe called bad divergence because the zero line has not been reached. The AO did not go back to the zero line, which means that in fact this is one ongoing movement on this 4-hour chart. And if we were to zoom into a 1-hour chart, then we might see that between these peaks, this valley has reached the zero line. That's possible, but it's a different time frame. You would have to go to the 1-hour chart. So there is a difference between divergence. You have to be careful regarding that zero line to really properly check if you have divergence, and then you know which time frame to look at. Let's see. We had a question if the second HL, because it's got a red line between the green. This small red line here is not, that important in my opinion regarding. It's not important regarding divergence and convergence in any case, because you're basically looking at the entire high, right? The entire tops. All right. So, okay, good. So that's just a quick explanation on that. Furthermore, what I think has very valid or very important value is regarding the edited wave count. It definitely takes away a lot of the guessing, a lot of the unknown factors, a lot of the thoughts that why or what is it. It definitely makes it more, in a way, mathematical and more straightforward, and a lot more functional and easier to use and more practical to actually implement it. If you look at the oscillator, you don't even have to know that much about the edited wave, in fact. Wave 1 has a peak that is always on the opposite side. So, for example, if you were in a downtrend, you would have divergence between the oscillator, which would mean something like this, something like this. And then the wave 1 would typically just cross the zero line, all right, or maybe even have a bit higher. You would have a retrace, and then that would go back to the zero line, but not too deep. And then wave 3 would have a typical very high and strong oscillator reading, all right? So you would have the classical divergence here between wave 3 and 5. Then you would have typically the wave 1 maybe to the other side, wave 2 here, wave 3. This will go back to the zero line. And then the next hump you would have for wave 5, this would be wave 4, and you would have divergence. So basically you see the classical setup where you have convergence between wave 1 and 3. The wave 2 would see the AO go back to the zero line. It would typically be a deep retracement. Wave 3 would have a very strong AO reading. Wave 4 would see the AO go back to the zero line, but would have a shallow retracement. And wave 5 would have typically divergence with wave 3. So you really don't have to know that much about edited wave, and just read the oscillator and you know what's going on, basically. Or you have a good chance of reading or interpreting the situation. Of course, when you have corrections, an ABC correction, things get a bit more complicated because the AO could either show convergence between wave A and C, or it could show divergence between wave A and C. All right, both are possible. There's not really a standard rule for that. So the corrections make, especially on bigger time frames, do make the situation sometimes more complicated. But if you just look at the fact that, for example, on a 1-hour chart, you have a strong AO reading and the move is back to the zero line, you know that you have minimum retracement, and sometimes that's all you need to know. All right. So this is a very important information for my trading. Here's a Euro-Yen 1-hour chart where you can see a classical, very strong AO reading here. And when this is pushing basically, this is the impulsive part. You can then zoom down in the time frame and use the multiple time frame analysis and go to 5 and 50-minute charts and try to catch longs within these areas. All right. You want to be careful maybe towards the end, hopefully, but you know what I mean. So you can use that advantage when this is growing to catch maybe smaller trades within that move up. All right. Basically, you see then the AO retrace all the way down to the zero line, reach the minimum requirement here to go to just below that zero line. You can see that the retracement itself was shallow shallow retracement, not an active retracement. Price just made a bull flag. The moving averages would do something like this, basically catching up to price just because of time factor, not much of due to a pip retracement. And when we reach the zero line here, the minimum requirement has been met, and we bounce again for the next move up. Here too, we reach the zero line, and then again, the next move is ready for continuation. Right? But we eventually have regular bearish divergence between these tops. It doesn't necessarily mean, though, that the upside is totally finished, finito, over. It's something that sometimes takes time to play out. You know, divergence is not something that immediately snap fulfills. You want to check for multiple divergences and time diverges on multiple time frames. So not only on the 1 hour, but maybe on the 4 hour and the day chart, and you have maybe double divergence on 1 hour. Then, of course, all of these factors help impact the likelihood that the trend is over and a bigger retracement or even a reversal might happen. This is the Euro-Yen 4-hour chart on the right side, and it's the same position where I have the red box. These red boxes, it's the same position. So you can see that a retracement here to the zero line was basically not a retracement to the zero line. It's just an ongoing move on the 4-hour chart still. All right. Here we did have a retracement to the zero line, and that's when we got a massive move up all the way from 117 to 127, 1,000 pip move on the EJ when we had hidden bullish divergence right here. That's when we have a higher low on price, but a lower low on the escalator. Hidden bullish divergence really sent this thing rocking to the upside. Small pause here and a continuation. Right? So definitely very valuable how you can use that for the divergence and the Elliott wave and understanding in what structure the market could be at the moment. Now, I also use it for distinguishing the separate legs, because basically what it means is that, as I already said, this move up is just one piece, all right, because probably it hasn't reached the zero line here, but you can see that all of these legs here are one legs, and you can distinguish that by looking at the oscillator. So it takes away the guessing. Price sometimes is confusing in a way. If you want to take the swing high, swing low, it could be, do you take that top, bottom, or here? This is quite simple in a way, but it does give an extra confirmation if you need it. All right, here too, just in case you were doubting, you can see what the swing highs, swing lows are. All right, so that's quite useful. The guideline here is that the point from zero line crossing to the next zero line crossing. And each of those legs is either impulsive or corrective, and whether that is impulsive or corrective and how you can explain it depends on Elliott wave. All Elliott wave does is just indicate if it's impulsive or corrective. And the whole market is basically impulsive, corrective all the time. And it's the market rhythm. I already talked about it. It's the way the currency moves. It's impulse, correction, correction, impulse, impulse, correction. So basically, that's very important to know, because you can get an indication where the currency could be going at depending on this. If the price has a lot of impulse bearish candles, well, then you know that the nature of the market is very impulsive to the downside. That's useful information. All right? Then maybe after that a correction is logical, and then continuation of that impulse. All right? So that in itself is very important. All right? You don't even have to know anything about Elliott wave, but looking at the impulse corrective is very important. But if you want to have an indication of what could be the next leg, would it be impulsive or corrective, the Elliott wave will help you explain that, and will give you a guidance on that. And all Elliott wave does is just match all those legs, match all those impulse and corrections, and tie them together and label them numbers and letters. That's all it is. It's all that. But you don't even need, you don't in theory need that. Fibs, very important, because you're looking at not only maybe would you want to wait for placing a new fib until the target has been hit. Why is that important? Because if you wait for the target to be hit, for example, you have an up move, you have a retracement to a fib and a bounce off a fib that goes to target. Then you can place a new fib, because if you do that earlier, basically you're still stuck in the same swing high, swing low. If you would fib anything within the blue top and bottom, anything within there, you're basically fibbing twice in the same area. So it's important to wait for placing a new fib until you get to target. Now, I don't always do that. I do use fib sometimes within this region on lower time frames, for example, especially. But it's good to be aware that you don't want to maybe over-fib it on the same time frame at least. Okay, you can zoom in, for example, to the area where I have the pink circle to find out if there's any fib for this B retracement for the next wave down. That makes sense. Okay, but you want to be careful about over-fibbing too many legs within a certain region. Okay. Also, that's one thing, but the AO can help also with the fib placement by knowing where the swing high, swing low is, and we know that by looking at the AO readings from 0 to the 0 line. Then you know that this is one swing high, swing low, and you can place a fib on that. All right. The only thing is that you want to be careful when you have a wave 1, 2, 3, 4, 5, is that you do not want to place a fib on the wave 5. Okay, that's something you want to be careful of, because that's actually the area where the currency could correct and do something like that. So then you want to fib the entire wave 5 wave up, because that's where the currency could find support again. All right? Otherwise, wave 1 and 3 and wave A's are fine, most of the time fine to fib. So here's some examples I have. Let me take a look. This is the Euro-dollar 4-hour downside. And basically showing where we had a crossover and where we had this major support level being broken. You can see we bounced off the moving average. We're saying how often the moving averages are support and resistance. So you can see here it's a support for the currency. We bounce up, but then broke, and then moved back to those moving averages and used it as resistance very nicely, as you see, consistently, over and over. We use that as resistance all the way down here in this beautiful downtrend until we got this bigger reversal, and there was some news event, some data got released, and we had a massive impulse to the upside here, which indicated that maybe this time the downtrend is over. Indeed, we got the upside. Now, if you look within that downside, we had the classical air retracements twice, right in here, and let's see, right here and here, perfect retracements for further continuation to the downside. Let's see, or I'm talking about divergence. Okay, a bit more actually. We had here, here, and here as well. Sorry, I was just looking at the circles, but you get the point. Anytime we moved back to the 0 line, it's a good indication. You can sharpen our knives in a way, sharpen our brains, because that's when the action could start. And not to say that when after the 0 line has been met, the currency couldn't be good for other shorts, but then you would want to zoom into a lower time frame. You can see clearly that this is the 4-hour trades upon the retracement here, and you get good falls, but and those could be good trades, but definitely those are trades on a lot lower time frame. Okay, this could be a great 1-hour pullback, for example, but on the 4-hour world, it's not a major retracement. It's a 1-hour retracement probably, which could be still a good entry for a short, but it's not a 4-hour heads up here. So within this down move, for example, you could have multiple 1-hour hooks backs that are still good until eventually the 4-hour world gets back to the 0 line as well. I already talked about this, so I guess it doesn't make sense to dive into that much more. We know about the fact that we need the minimum retracement requirement for not only for the swing high, swing low, but knowing when the retracement is finished, and knowing when we can continue, and knowing the elliott waves as well. So that's why the 0 line is important. Just to summarize, we already talked about that. And last but not least, regarding the AO strategy, 44-hour one we discussed in the webinar on intra-week strategies. All right, that is an integral part, or actually the essential part, basically, of that strategy. So, all right. So, just to give a heads up for that, if you're interested, take a look at that webinar. That summarizes my my take on the AO. As you can see, very passionate about it. and very excited about it. So I hope to have given you some inspiration, maybe to at least try it yourself if you would like, or the MACD. But hopefully maybe you learn some extra usages and why I think it's so valuable. All right. So if you have questions, let me know. In the meantime, I'll answer those. We do have Kosik asked, thanking me for a guideline. Let's see. Yes, definitely we'll do that, Kosik. No problem. And I'll just wait for your questions. But in the meantime, I'll pass it over. No. Oh, there's some tips still. Sorry, I thought that was the last slide. Let's see. What does it say here? Use the AO on multiple time frames. Yes, definitely. It's a good tip. Use this AO for multiple time frames because you'll be able to piece together the currency and see what would be a good retracement or not. What else does it say here? It gives a tip about using it with Fibonacci levels. Yes, definitely. Already talked about that. And yeah, higher time frame. You can, for example, look on the higher time frame for retracement, and then look at a lower time frame, for example, for divergence between the retracement tops, a target, Fibonacci target to be hit, a change of histogram color on the lower time frame. So, for example, if you have a 4-hour world where the AO is retracing to the 0 line, and then you zoom into the 1-hour chart, and on that you see the AO turning back from green to red, well, that could be an indication that, you know, the upside correction is over, and we got downtrend starting very soon. So you can use all these multiple elements for a coherent analysis there. Elkana is asking if I can suggest a good book about AO. Yeah, anything really regarding Bill Williams you would have to read. I forgot the name of the book at the moment. Classical book where he dives into also his other indicators. But you have to look for the author then, Bill Williams. I can't come up with the name at the moment. Sorry about that. But Bill Williams is the author for sure. Here are some indications, for example, on the 1-hour chart or 4-hour chart, pound dollar, where you have a divergence between these tops. All right. Price moves down. You get the AO turning here at the retracement. That's exactly where we get the upside continuation. And if you zoom into that place where we had the AO 4-hour and look at the, oh no, this is a different currency actually. Okay. Well, here too, the AO back to the 0 line, and the trend continues after that dip. So basically here the moving averages were resistance, here the moving averages are support, and up we go. Thank you, Bogdan. Indeed, Trading Chaos. That is the name, or one of the names that one of his important books. Okay. Alrighty, that wraps it up. Thanks for the questions. If you have anything else, yeah, I'm only focusing on the AO here. Indeed, sorry, there was one more question. If I only use AO, no, I use MACD. I have and stochastic as well. I look at those two. I put on a separate template, basically. But the primary one for me, in most cases, is indeed AO. Okay. All right. Any other questions? I'll just answer after T has finished his explanation of his great strategy here.
Well, guys, yeah, excellent explanation of awesome oscillator. I think the other book is called Trading Profitability or something like that by Bill Williams. You can also find a good information about a lot of information about awesome oscillator. I think it's Trading Chaos and Trading Profitability. It's called. So try to search for it. Also, in this strategy, I will explain. We will combine leading indicator, Williams percent range, momentum indicator, RSI, that's a momentum indicator, and moving average as a lagging indicator which confirms the trend. So, as we already know, as I told you, Williams percent range, for those who don't know, is indicator. It's a sort of oscillator family of technical indicators, and it's based on a stochastic indicator but without a smoothing component and with a reversed scale. Williams percent range indicator is excellent in its ability to signal a reversal and also in ability to signal early trade entry. Also, we can use indicators to determine overbought and oversold conditions in the market. Then we have momentum RSI relative strength index that is excellent tool as a momentum indicator, and moving averages as dynamic levels of support and resistance. In this case, they will define a pullback and a trend. So Williams percent range should be applied as 21, period of 21. RSI should be applied as 9 period. We have 40 EMA and 80 EMA exponential moving average. Let me explain again what exponential moving average is. It's weighting of moving average is done exponentially. As we move to the left on the chart towards past values, the weighting they receive in the computation of the moving average decrease rapidly. It's very faster, much faster than it would be in a linear progression. So the conclusion is that most recent prices are far more significant. So we use EMA in this kind of strategy in 5-minute time frame. So this strategy is strategy for 5-minute time frame. Then we will have rules for longs and shorts. Rules for longs are 40 EMA must be above 8 EMA. Then we wait for a pullback to or close to 40 EMA. Then Williams indicator must be below -80 and then go through and close above -80. RSI must be above or at 50 and going up. So RSI must be above or at 50 and going up. So it should be at least touching the 50 level, but it should be pointing to the north side. We trade towards 5 minutes or 1 hour resistance. 5-minute resistance we use by naked eyes. I will show you that on later examples. And 1 hour resistance we use by using hourly pivot point indicator. Hourly pivot point indicator. So, guys, I already told you, if you want to scalp the market, don't use daily pivot points. Use 1 hour or hourly pivot point indicator. So I will now show you this. The rules for shorts are basically the same, but in our next slide you will see what does it all mean. So first we open a 5-minute time frame, then we place all indicators on the chart. So first we see that this is a downtrend, but we need all of those, but those are simple indicators, classical, and we use only those 3. So moving averages as support and resistance, then Williams percent range as entry indicator leading, and RSI as a lagging or momentum indicator. In this case it's a momentum. Although it can be a leading, now we are using it as a momentum indicator because we applied 50 level. When we have 70 and 30 level, then we can say that RSI is a leading indicator. When we apply only 50 level, then it's a momentum indicator. So it's unique in its possibility to be a sort of in leading, both leading and lagging. Then we wait for pullback. You see there is a pullback. Price has touched red and is touched blue level. Then we can see that Williams percent range went above -20 but close below -20. It should not be very, very, very close to -80. So this is red line where all indicators confirm the movement. Then we can see that RSI is below 50. So the momentum is to the downside after the pullback in bearish trending market. These moving averages are support and resistance levels of higher time frames. So blue is above red, that means the market on a higher time frame is bearish. We can see Williams, we can see RSI, and then we enter a short trade. The first target is 5-minute support. You can see it by eye because we have wicks on the left side from the price, so that is 5-minute support, the last known support. So we trade towards 5-minute support or towards 1 hour support. In this case, because the market has had some movement, you need always to apply common sense. You see the movement from the 5 minutes perspective, it was really huge. Then we will try to exploit this swing into the support. So we enter here at the market and we exit close to support, and that is trade good for some 25 pips. But we need rules to be respected, as I said. Vice versa is for long trades. We can see our next slide where we will combine all of those indicators for a long trade. So this is again arrow and the red vertical line. So you see the price is first, we have a bullish trend because after the consolidation move we can see that the price has been forming swings to the upside. Higher high and higher low, and then moving averages show a sort of divergence. They're expanding. Again, Williams percent range went below -80, then it closes above -80, and RSI is going above 50 and to the upside. So we enter the second candle after the retracement. I have marked it with a red vertical line. We can trade towards 5-minute resistance, but since it's very close to resistance and the resistance in the next candle has already been broken, then we trade towards 1 hour resistance, and we can see that 1 hour resistance signal by hourly pivot point indicator has been hit. I couldn't put hourly pivot point indicator do a copyright issues, but you can always buy it or Google it. It's IBFX hourly pivot point indicator, Google or buy it. So it will signal next resistance on our time frame. The best combination is always to use, again, leading indicator, lagging indicator, and moving average as support and resistance, and to determine a trend. And for those levels, if you cannot determine it by yourself, you can use hourly pivot point on 5-minute time frame, because it's used mostly for scalps and scalp swings. So this is an example of a long trade and how to combine effective strategy with minimum use of indicators. I will say it again, never go with more than two indicators. First is leading, second is lagging indicator, and you can add third indicator, for example, as moving average, because those are levels again of support and resistance, and they give you a trend direction, because these moving averages are a reflection of a higher time frame. It's a reflection of higher time frame because we put it as exponential moving averages with 40 and 80 periods, so they are reflecting higher time frame. If you add hourly pivot points, it's not a stacking indicator. It will give you target prices. It can give you stop losses, hourly pivot point indicator. But never combine, for example, stochastics and Williams, MACD and awesome indicator, RSI, MACD, Williams, everything stacked up. That doesn't make any sense. Whoever tells you different story, he is lying. Believe me, guys, I have tested it so many times. The more indicators you have on your charts, the more confused you will be, and it will give you a false signal. So all of these indicators are basically reflecting the price. we need the price to reflect a possible future and the present, and we need to see the price reflecting to the past. That's why we combine only one of them. One leading, one lagging, and one support and dynamic support and resistance indicator and trend strength, that is moving average. But adding on this example, MACD, adding awesome or something like that will never be profitable. They're filtering too much of each other, and there is no point, because most successful of those indicators in percentage will prevail. So you don't need to stack. Because I know that many traders ask me, how come that they sell those systems for such a small price of $97 and $200? Because they are effectively using their custom-made indicators derived from all of these classical indicators, and they're showing bad results. They wouldn't never show you real statement of how the system has performed. They would never tell you a truth about those indicators. And together, me and Chris today, I think that we opened eyes for many of you who trade using the indicators. And the main thing you learned here, again, is never to combine more than one of each category: leading, lagging, and dynamic support and resistance. So if you have any further questions, don't hesitate to ask, because we are finished with our webinar. I will thank you for all of your attention. Of course, Admiral Market supports us. It's our host, very low spreads, excellent support. Don't forget to like on Facebook page. Don't forget to attend my personal webinars, Chris live trading webinars, and our mutual webinars, which when we work together, me and Chris. So you will learn a lot about trading, range markets, counter trend trading. We will show you, we will use some of those indicators we mentioned today. So it's a good thing to listen to this webinar again if you have any further question. Concerning divergence and that webinar that hasn't been uploaded, I will have a word with some of Admiral Markets representatives to ask them maybe if can we work it again. I will gladly present that webinar again, me and Chris. So if you want to attend, I think that we will manage to have the webinar about divergence. Many people asked me about it, and I'm sorry it wasn't recorded, but we will do it again, I think.
Yeah, exactly. The FIBS one as well. It's a good idea.
No problem. We can do that again. No problem.
Yes, exactly. We can maybe combine it in a way, see if that's possible. We can talk about it if that is feasible at all. But that's a good point. I'll write that down because I forgot. Actually, it was on my list, mental list, but I'll put it in on my to-do list. Indeed, good point. We can talk about that.
So this is a question: how will this indicator work on long time frame instead of empire? And on longer time frame, I haven't tested it because EMAs are mostly used on a lower time frame. Mostly used. Also, hourly pivot point indicator is used for scalping purposes. It's hourly pivot point. It changes every hour. And Williams percent range and RSI have settings for 5-minute time frame. So it's tested on the 5-minute time frame. Try to test it on longer, but I think the other settings should be implied, so I don't think it's very possible to use it on higher time frame. We have already talked about moving averages. They represent higher time frame direction. So basically you're looking on M5 for entry, but you have those moving averages which will give you higher time frame trend. So it's used on 5 minutes exclusively. Yes, Williams 21 is needed to be put in the period box, 21. Is this recording available for later view? Yeah, I think it is, because this session is being recorded. Thank you very much. This is my first webinar. Indira, thank you for attending. You are very welcome. I hope that we will see you again. You can learn a lot from us. So, no problem. What's execution speed of multi-terminal? I don't know. I just know that Admiral Markets Mac account used for managing accounts and used for my personal account, it's very fast response. I have never had any requotes. I have never had any problems with execution. I am very satisfied with the execution of the platform. So don't worry about it. Do you know any good strategy for scalp? Yes, we know of very good strategies. We already explained on our scalping webinars, so you can try to search for it on Admiral Markets recorded webinars. Any ebook you can recommend for scalping? No ebook for scalping. Try to search on Google or on our webinar. It was recorded, Gary. It was recorded, so you can find good strategies for scalping. No ebooks, though all of those ebooks are available for free at Google, and you know, you should never pay for it. It's already has been established. Oh, sorry. Then I have another question. Chris, do you see this?
Where do you offer webinars? Monday, right? You have one.
Ah, Monday. Yes, Monday webinars. Monday 6 o'clock Central Time. How to access your personal webinars mentioned a few minutes ago? Well, you can apply for it. You can apply. It's on Mondays. My webinars are on Mondays. Every Monday I will go on my summer holiday, but I will be back very soon. So next Monday we will have a webinar. Then Chris will do it alone, but I'll be back around the 10th or 15th of August. But I will be available starting from 10th of August. So we will have it already scheduled, so don't worry. You can apply on for next Monday on Admiral Markets website webinars, and you can apply. There is my name, Nenad, and I will see you on Monday probably.
By the way, next week we have a webinar on Wednesday, so it's one day earlier than usual.
Wednesday.
Yeah. Just to emphasize, same time though, 6 o'clock. So I wish you all a great weekend, I guess. Or still a good trading day tomorrow.
Yes, so let's answer, Chris, please, let's answer one more question and then we can call it a day. What category?
I thought that was it, sorry.
What category does ADX plus DMI and ATR indicators belong to? ADX indicator is basically, it's a bit of a lagging indicator. ATR is not the same. ATR is not a classical indicator. It only gives you a range. It gives you numbers. So we already explained, I think, in one of our webinars. ATR will give you a % range of that particular currency exchange rate. So you can try to use it only as a matter. Don't go long into resistance or don't go short into support. If ATR is already above 100%. So you can try to use it as a reversal indicator, but it's not a classical indicator. ADX and DMI, I don't use it. I tested it and I was very unhappy with results, so it's for me a waste of time. Thank you guys for attending. See you on Wednesday. Me and Chris will do it together. And for our personal webinars, again, go guys on Admiral Markets website, try to see education, try to under education webinars. You can apply for both mine, Chris, and our mutual webinars. So just visit admiralmarkets.com and you can apply there. Thank you very much for attending, and see you very, very soon.
Yes, have a great evening and a great trading day and already a great weekend. Cheers, everyone.
Cheers. Bye-bye.
For your